Welcome to the Dakota Research Podcast. This podcast is for informational purposes only and should not be considered investment, legal, or financial advice. The views expressed are those of the speakers and do not necessarily reflect the opinions of Dakota or its affiliates. We do not provide investment recommendations or solicit investments in any securities or funds. Listeners should conduct their own research before making any investment decisions. Hello, everyone, and welcome back to the Dakota Research Podcast. This is episode 8. We are very excited to have been doing this now for 2 months. We're going to keep doing it. It's been a lot of fun. As ever, today we will be going through our usual agenda. We have a really fun deep dive topic today where we'll be talking about early stage VC. It's going to be a lot of fun. Obviously, it's very sort of sexy asset class, so it'll be fun to talk about. A lot of good companies we'll be able to reference as portfolio companies and the like. We'll also talk fundraising news, deal news, key people moves, and then we'll wrap it up with upcoming events, show notes, and Q&A. On the Q&A topic, put your questions in the chat. We will be answering them live. If you're listening in live, if you're listening into this on Spotify or Apple, don't forget to like, subscribe, share this with an industry peer and colleague. We are very excited to be welcoming more and more people to this podcast every week, and we're going to keep that up.
And when you think about, too, the library that's building right now, I mean, we covered energy investing last week. We had a great deep dive special feature of blue water energy, too. Today, we're talking about early stage venture. We've covered a lot, too, infrastructure and some podcasts. So you kind of look back and you think about, wow, like different areas that we've talked about, the funds, the news developments. We've even tracked some news, too, that have occurred, like the EQT example, a lot of changes there too a couple weeks ago. So I think it's just great to follow along and kind of keep up with the narrative too. There's so much going on in the private markets.
There's a ton going on, so let's get right into it, huh?
Sure.
We start out with here in our backyard, some news with Hamilton Lane.
Yeah, absolutely. So this was an interesting piece of news that we pulled out this week, and Hamilton Lane is going to offer a U.S. infra energy fund for retail investors. So obviously Hamilton Lane's been well known for their institutional business too, but they're continuing to push into the retail market with another evergreen fund, this one focused on infrastructure. This basically have launched the Hamilton Lane Private Infrastructure Fund, or HLPIF, the first private infrastructure vehicle available to U.S. retail investors. The fund's offered via the Republic platform, so a partnership they built with them. This is the point that I thought was so interesting. It's a $500 minimum, so folks like us can invest in it. It's not necessarily a $5 million minimum, but it's $500 minimum, which is super exciting. I mean, there's a lot more strategies like this coming out, but a lot of the evergreen funds have been around $100,000, $250,000 minimums. This one much lower. The fund's going to provide diversified global infrastructure exposure through one single investment, one single line item. So when you think about a wealth advisor, other groups that are managing client portfolios, how they can quickly integrate this and follow it from a reporting standpoint. A neat tech aspect of this product in particular is that they actually utilize blockchain technology.
Wow.
Yeah. So tokenization, so to enable fractional ownership and improve transparency of the fund itself. So a lot more going on in that world. We're kind of seeing a blend of both, the crypto and the blockchain technologies and private markets too, where there's been, obviously a big push to increase transparency, increase in transfer ownership in a more liquid fashion. So this is on display here with Hamilton Lane, very innovative firm. One other thing to call out just on the terms too, they plan to offer quarterly repurchases of up to 5% of net assets to support liquidity. Why this matters, again, this opens up access to institutional grade private infrastructure investments for non-accredited retail investors specifically, targeting longer dated assets. These are high barrier assets in the growing but $1.2 trillion infrastructure market. It enhances capital accessibility through the tokenization real world assets too as well. And then it supports a broader trend of democratizing private markets and expanding investor inclusion. So just an interesting story there, well-known firm right in our backyard. Yeah. I thought it'd be fun to call out.
That is fun. You mentioned the quarterly redemption windows too, which is obviously enticing for a retail investor who may not want the same level of a lockup as an institution.
Yeah, it's a great point you make.
I've not heard of the Republic platform until now, though. You hear of Yield Street. I've heard of actually something called Public. You hear a bunch of these different platforms that allow access to private markets and alternatives for the retail investor, but this is not one that I have heard of. And if you're listening in, go to their website. It's interesting. I'll say that.
Yeah, I think too, a lot of what's going on now are platforms are differentiating themselves by having these types of product offerings on there too. So I think that could be some of that too as well going on.
Yeah, it's I mean, we could do a whole episode on just what they offer, because now here I am on their website and it's offering me with a $500 minimum the access to buy and sell deals on the secondary market. So
wow,
we have to get a better understanding of how that company works, which we totally should. And then maybe we do a deep dive segment on these like retail democratization platforms, Yield Street, Republic, all of these.
I mean, the technology stack too. I mean, we got to get our arms around that. If this is going to be a growing trend, if people are going to be using tokenization to kind of broaden access to, we really got to focus on who are the key players there and what kind of technology is out there.
Totally. Next up, we've got a pretty big collab that's happening here on the private credit side.
Private credit space, DWS and Deutsche Bank launching a private credit collab. What is it? This strategic partnership. It's going to help expand access to private credit opportunities for DWS clients specifically. The agreement gives DWS preferred access to select private credit assets originated by Deutsche Bank. So you can see the partnership working well there, including asset-based finance and direct lending. These opportunities will bolster DWS's 110 billion euro alternatives platform. Additional point to note, Patrick Connors, who's Deutsche Bank's European head of global credit financing and solutions, will join WS as the global head of private credit. Why it's significant. This strengthens DWS's ability to offer differentiated private credit exposure amid growing investor demand for real economy yield generating assets. So people continue to search for yield. Private credit's one asset class people tend to pick up to enhance their yield in their portfolio. It also leverages Deutsche Bank's origination capabilities to deepen DWS's product set, a rapidly expanding asset class. So, strategic importance with both, institutional and high net worth kind of implications here. The appointment also of Connors brings deep expertise, and the newly scaled effort, helps align origination with investment execution. So, something to follow in the private credit space. Obviously, too, DWS is a publicly traded firm, so we'll be able to get more materials on that too as well.
Yeah, it's exciting. We'll move to the fundraising highlights.
Yeah, there's a lot going on there too. A couple of notable funds.
It is. I can't stop looking at the Republic website. I'm going to jump back to that, but right now I'm on there, and Eli Roth is a film director. He did Hostel and many other like horror movies.
Sure.
Right now he is raising $5 million to start his own independent horror film studio, and you can invest in that with a minimum of $100 on that Republic platform.
I mean, how good was Hostel?
Hostel was pretty good. I didn't love the sequel, but yeah. Anyway, I'll get off that website so I stop being distracted. But
so Turn River Capital, what's going on there?
Turn River, nothing horror about this. Turn River has closed Fund 7 at $2.5 billion hard cap. That was significantly oversubscribed, which is always exciting to see. That nearly doubled the size of Fund 5. It actually was $1 billion, over $1 billion more. Turn River, if you're not familiar, private equity firm rather. They invest in growth equity, buyouts, spinouts, and recapitalizations of software companies here in North America and in Europe. They've invested in a handful of names you may recognize: Mailgun, Pearsoft, Invicti, pretty large ones that they've had. Why does this matter? I think just the scale up from Fund 5 to Fund 6 just really shows this growing demand in specialized firms.
Yeah, software.
Yeah, specialized software focused firms, but even just across the board. We just did a episode on our fundraising news podcast about we talked about aviation specialists. So you're really just seeing these like specific industry experts who are going in and, creating these strategies that aren't investing across everything. They're just investing in their one vertical and staying in their lane, and it's working really well.
Yeah, and I think too, when you get the right groups too, where they're aligned. I mean, these are big and growing markets. The software market's extremely complex. It's large. It's changing all the time. There's a lot of different aspects just to software specifically. But when you think about, the specialization component to it, really these teams too have, clear playbook too, and it's able to them, rinse, wash, repeat over and over again. So, look forward to following this one too. There was also some, they were in the news recently too for a notable take private as well.
They were. That was SolarWinds. Yep. Yeah, SolarWinds. That was a $4.4 billion transaction, which is pretty interesting, right?
SolarWinds was invested out of Fund 6, I believe. And we're seeing a lot more take privates too. It's interesting, despite again where kind of the equity markets still trade. I mean, I know we had a pullback recently, but it's rebounded a little bit. But particularly in kind of the information technology sector, valuations still remain high. So when you think about picking apart opportunities, dislocations, like we are seeing more take privates. And why is that? I think that's because you needed private capital to better align kind of with a business plan and not have the turnover of public shareholders necessarily in a line set like a 3 to 5 year goal. Also, I'm sure SolarWinds too, a lot of these times when you look at kind of the value creation split between just kind of traditional sponsor to sponsor or founder to sponsor and then an exit to a strategic, a lot of times what happens in these take private transactions is there's like a compression in multiple just because the public markets are fairly inefficient at times. And when, something's not going well for a company, that multiple compresses very quickly, despite it maybe being a, quality, durable business. And in this case, I think, there can be sometimes, I think, quick, ability to get in, purchase a company because the multiple goes impressed, and then the value creation's, really geared towards that multiple, reflating over time too. So be following that story very closely, but it's also been in private equity hands before, I believe, with Thoma Bravo. So interesting deal nonetheless.
Yeah, I love it. I mean, the take private is something that's happening more and more, and we'll be launching our portfolio company data here soon. So if you're a firm listening in that does take privates and does participate in that type of strategy, we'll have something for you.
Yeah, let's just spend like a couple seconds on that too, because I think it's pretty interesting. So like out of all the news flow, out of all the information that we collect at the firm, like what kind of information are we collecting on these like M&A, these kind of transactions?
Yeah, so we're collecting a ton of the financial data, which I'll let you just walk through what we're doing on that side. But for what we're collecting for the end user, be able to go into a private equity firm and see, here are all of their portfolio companies. When did they invest in them? Are they currently invested, or did they already, have an exit or an event happen? What was that event that happened? Sort by industry, sort by sector, sort by sub-industry. Information on who's the CEO of the private company that they have acquired or sold, who are the board members, and really just find the full picture of the firm.
So if I'm basically on a buy side or something like that, or even on the sell side too, and I'm interested in finding actionable deals or just trying to get up to speed on the market, this is a novel tool to be able to get quickly. Oh, I didn't know I know that CEO. I know that I just had a call with that person specifically. Like having all that deal level data, transaction values, who's invested, the financing rounds, things like that. Just like incredible granular data that we're picking up
totally.
each day.
Yeah, if you're a banker and you're covering sponsors, right, and you cover 12, 15 private equity firms, we'll have all of them and exactly who they've invested in, so you can stop worrying about making sure your CRM is up to date and doing those monthly calls and just focus on
what matters most. Yeah, totally. Well, going back to kind of the key deals and news that we were talking about earlier, Credit Specialist Marathon has raised $2.7 billion for its opportunistic fund. This would be MDCF Fund 2. As I mentioned, $2.7 billion in total commitments, including affiliated and co-investment vehicles. The fund launched in July 2023 with a $250,000 minimum investment and follows the first fund, which closed, I believe, in 2020. It targets direct origination, private credit, and flexible credit solutions for management teams, PE sponsors, and founders across US and Europe. Notable LPs that we've tracked through Dakota data include Los Angeles Water and Power Employees Retirement Plan. They committed somewhere north of, I believe, $100 or $100 million, which is a pretty astounding figure when you think about it. Why it's significant, just demonstrates sustained institutional demand for flexibility, opportunistic credit strategies amid ongoing market dislocations and tightening bank lending. It further enhances Marathon's credit platform, which is deployed, I believe, over $75 billion in direct lending and opportunistic credit, and $30 billion plus in asset-based lending to date, which incredible numbers. Hard to get my mind around that. Yeah, and just really reinforces this broader PE credit trend of capitalizing on mid-market financing gaps and disintermediation opportunities. So Marathon Asset Management, Opportunistic Credit Fund, continue to follow that one too as well.
Yep.
We had some key deal announcements.
We did, and Chris, you put the script together today, and I'm pissed that you made me talk about this one. As a lifelong Sixers fan and season ticket holder until this year, they've officially lost me. But the Celtics.
It's a big number.
Yeah, wow. The Celtics bought for $6.1 billion. Unbelievable. Obviously, they've had 18 NBA championships now. Their most recent this past year. Their next probably this coming year. They're unbelievable. Hard to see anyone stopping them. A consortium that was led by Symphony Technology Group's co-founder Bill Chisholm has acquired the Celtics. It's the highest valuation ever for a North America sports franchise. So move over Dallas Cowboys. There's a new player in town. Notable backers outside of Symphony, Sixth Street Partners and Bruce Beal Jr., as well as Wick Grausbeck will be staying on as CEO and governor until the 2028 season ends. It's just to sort of ensure that leadership continuity that they want. They've obviously been doing something right. They don't want to shake it all up.
There's a timing element too. You mentioned championship last year.
Totally, yeah. I wouldn't have thought they were for sale, to be honest. I mean, we just talked a lot about sports investing. We did a whole deep dive. If you didn't listen in, go listen in. But we talked a lot about the rising valuations in sports assets. Here we go. The NBA is down 40% in ratings this year. but yet the NBA champions had the highest sports valuation of all time. It's just such a, I don't even know how to describe it. It's something you wouldn't think would happen.
It seems like in basketball too, maybe it's part of the league dynamics, the viewership, the changes, the way, teams progress and evolve too, versus maybe like the NFL or something like that. I mean, to your point, it seems to me like what's going on here in Philadelphia differs than what's going on in Boston, clearly. I mean, if you kind of strike the nav today. Mm-hmm. So probably a lot more separation. We talked a little bit about 6th Street in that sports podcast, which is really interesting. Kind of they're become a powerhouse in the sports investing world too, and creating these, financing structures to get access and open up exposure to for their end LPs.
Yeah. I mean, Adam Silver has been a great commissioner for the NBA, so I'm sure he'll, navigate them through this time of, down viewership. There's so many questions about the game just not being as entertaining anymore. But 6th Street saw something, so I'm sure there's something good coming.
Yeah. Also, with something good that's coming is Google. They're going to acquire Wiz for $32 billion. This headline was really interesting, one we wanted to talk about for a second, because this was a transaction that almost went through, I believe, a year or two ago, and then Google decided to put it on ice. But now here they are back again to acquire a cloud security startup, Wiz, for $32 billion, making it the largest acquisition ever. The deal aims to strengthen Google's cybersecurity capabilities, particularly in the context of cloud computing and AI growth. So obviously this is squarely where the puck is headed, or is currently, and thinking about where the gaps are for the company. Wiz, once seen as a strong IPO candidate, opted for a strategic sale amid ongoing market volatility and regulatory pressures around the public listing itself. So I believe the transaction has to go through a normal regulatory process too. So there's some hurdles there that they have to get to, but new administration, new team in town, really thinking about how Google can make this acquisition. And, again, very, very largeable size. I want to say this is probably the largest acquisition Google's ever made of a company. But again, why it matters. So this reinforces the shift towards M&A as a preferred exit route for high growth tech startups, when the public markets, the IPO market, a little bit more challenging there. But it's definitely reassuring to see kind of the strategic tech M&A again in focus, especially as hyperscalers prioritize cybersecurity amid rising AI adoption. I know we're very, AI first here at Dakota, and thinking about, all these new products, all these new capabilities we have at our fingertips, making sure that's secure, and Google being able to have a solutions offering for their business and their customers. Again, there's a regulatory hurdle. I'm sure there's gonna be a lot of press about this as time progresses, but nonetheless, it was also a tremendous exit for their VC backers too as well. I think I saw some of them achieving over 25 times return on this deal. So tip of the hat to them, in making a great investment.
Yeah, and it'll be interesting to see. Obviously, there's some antitrust situations that might pop up here, so we'll see if it ends up going through smoothly. Hope for everyone involved that it does.
So we're talking about early stage venture capital here shortly, but another notable people move that we want to call out in the people move section was Michael Siebel, long-standing member of Y Combinator, is actually set to leave. Which Y Combinator is always in the news for making early stage investments, and some of the most notable firms, I believe Airbnb was Y Combinator. DoorDash. You just these are all household names. And Stripe. I forgot about that too. So he's stepping down as managing director and group partner at Y Combinator after a decade of leadership. He joined back in 2013, played a central role in scaling the accelerator, also building a global presence for the firm. He didn't announce what his next role will be, so I think that's kind of more to come there. But we need to see also, they have obviously deep bench of talent at Y Combinator to pick from. So, but it'll be interesting to see what he goes. Will he remain in the early stage startup ecosystem? Will he start his own firm? I mean, I think LPs are all probably asking the same question. It'd be interesting to hear, kind of be in the room about those conversations right now. What are going on? Maybe some, new fund that he might launch.
Yeah, I mean, being there for 12 years and, I'm seeing here that it was actually him who mentored those three examples that we just walked through, Airbnb, DoorDash, and Stripe. Yeah. Okay. So he's got the experience. Who knows what he could do? I mean, he could even go and be an operator. He could certainly be a CEO. Who knows?
Absolutely. There's some news out of Blue Owl too. Some people moves there.
Yeah, Blue Owl, they've made a big hire. They have taken Blake Shorthouse to lead their, his title is going to be Global Head of Family Capital. He is coming over from KKR, so a good win there, getting that Got to switch over. Previously, he covered ultra high net worth at Credit Suisse, UBS, and then at UBS, he was primarily involved in the EMEA and Asia team, covering the family office teams there. Blue Owl currently serves over 250 family office clients who've committed over $6 billion in equity. Why does it matter? Well, that right there is why it matters. But it really just continues to signal the intent for them to scale their family office franchise globally. His experience at KKR and previously should help them just better navigate this world, particularly his experience with Asia and EMEA in tandem with his experience in the US. It's kind of the perfect combination of how we can navigate sort of cross-border wealth transformation.
Going international, I think it's just all about continuing to get scale there. Those are some of the largest pools of wealth globally in those markets too. So there's a lot of opportunity to think about integrations. And there's a lot of solutions that I believe Blue Owl provides that are not necessarily already met in those markets today. So it makes a ton of sense why they're doing it and just getting further integrated within those wealth channels.
Yeah, and they're further integration, right? But they're continuing to expand these wealth channels. We just covered recently that they hired Rosamund Price to lead the Europe, Middle East, and Asia private wealth team.
Yep.
So another big private wealth hire here that they've made. So they're keeping down that path. I mean, why wouldn't they? That's where all the money's going to be.
So just this is a further doubling down then in those channels. Got it.
Well, great. Let's just keep rolling. We can jump into topic 2. Today, our deep dive is on early stage venture. Again, if you haven't yet, toss in the comments if you'd rather us do a deep dive on a different topic another day. We're happy to take suggestions and recommendations. Let's jump into it though. Chris, what is early stage venture capital?
Yeah, and I mean, just kind of to kick things off too, just like what got me interesting too, I sat down a week or two ago with the founder of Blue Owl Ventures, who has Reid Hoffman as one of her early LPs and also on her advisory board. And we got talking about AI early stage investing and just think about how much is moving too. I mean, there's a lot of, sort of slower deployment more recently just around kind of the late stage growth part of the market, but early stage continues to chug along. And when you think about innovation, like really never stops too. Mm-hmm. But so how do these companies get financing? Wanted to really focus on this part of the market and kind of just lay the groundwork for folks that are maybe kind of interesting thinking about it too. We've got a couple of charts we're going to pull up as well, but as we go along, another thing to call out too, despite sort of the headline valuations getting a little frothy at sort of the growth end of the market, pre-IPO market, where some of the bottlenecks occurring, early stage valuations, particularly some of the incubations part of the market, like Y Combinator's focus on Series A and B, these valuations are pretty steady because obviously these companies are at a different point in their life cycle. But we'll get into it a little bit further. So just kind of set the stage, early stage venture capital. This is the funding that startups receive in the early stages of their life cycle. So typically, as I mentioned, pre-seed, seed, Series A rounds. These are the most formative moments of a startup's journey when they're just developed an idea, a prototype, a minimal viable product, and they're looking to raise capital to further develop the product, validate product market fit, and start to begin scaling. At this stage, startups are extremely high risk. So obviously people are, understand that, but also there are large outcomes too. Making a pool of investments, you're hoping a couple hit, but to overcompensate for the risks that are being endured. Part of that is the reason because these are often pre-revenue and they're still refining their business models, but they also carry the highest degree for potential outsized returns. So that's why early stage VC is something called investing at the ground floor. So why does early stage venture capital matter? Venture capital doesn't just fund startups, it helps accelerate them. So early stage funding helps a couple of things: build and refine their product or service, hire initial team members. So this could be not just the CEO or founder, but this could include bringing in, a very senior sales lead to it. It could be CFO building out like someone on the product side of things, which I know you know more about. And then also building out kind of the board at early days to get, some, institutionalization building around the business. This also could be for conducting market research, also launch go-to-market strategy specifically, and most importantly, really start to scale. But VC is more than money. Good investors also bring network, guidance, mentorship, which are often just as valuable. Rana at Blue Owl Ventures talked a lot about mentorship and the networks being a critical advantage from both sourcing deals, but also mentoring these founders as they're thinking about the big pain points as companies, try to scale and what are the issues at that point in time. They also may help recruit talent, shape strategy, and open to partnerships for future funding as well too. So There's a couple stages. I know you're going to take that.
Yep.
But just that wanted to set the stage there.
Yeah, let's talk through just the different stages of early stage VC. So first, you obviously have pre-seed that you just mentioned. So this is the earliest stage. It's literally pre-seed. Sounds like it in the name. This is where founders are still typically validating their idea.
They have a prototype.
Might have a prototype. Maybe you're still even working on getting the technical requirements needed to get an actual true prototype, but definitely have an idea. Conducting early market tests, setting up the legal structures. Funding here typically comes from other founders, the founders, and then their peers, friends, families, angel investors, occasional backing from pre-seed funds like a Seed Camp or a K9 Ventures. But you really don't start to see the venture money start coming in until this next stage, which would be the seed stage, right? So now you've moved past pre-seed, you have a prototype, you maybe have an MVP, you're starting to get some early traction.
MVP, minimal viable product.
Yep.
Okay.
Yeah, you're starting to get some early traction, customers, pilot programs, maybe a beta. You're seeing some user growth. The capital you've raised so far, you've used to maybe get a salesperson, maybe get a product team, maybe get the product rolling, and now you might look to include accelerators, right? That's like a Y Combinator, right? Where they'll give you, a certain amount of money to dedicate your time to building your business, right? So at the seed level, at the pre-seed level, many of these people may have had other jobs that they were doing and were just sort of tinkering around with an idea in the background. So now seed stage has become, a thing, right? So this is where you get, a Techstars, maybe more angel investors, maybe VC firms. Dilution at this stage really does start to begin. This is where you may lose, 15 to 25% of ownership in the business.
In the pre-seed stage, and we'll pull up some stats too, I think, around kind of ownership, but also kind of the ticket, the investment minimum amounts, or kind of the dollar amounts that are kind of going across each of these stages to give people some scale and size of how much is being invested in the business. But yeah, I mean, when you think about the founder, like reducing their equity stake as they take in new investors, there's also dilution each round as you go. So when you think about some of these big exits, you have to keep in mind too, like what is their end ownership? Is it 5% at the end of the day that Sequoia owns of Wiz or something like that, but could still drive these outcomes? So it's not like 100% or 50% ownership like it might be in buyout. There's dilution along the way.
Yeah, and then finally you get to Series A. This is sort of our first institutional round. A company's had signs of a product market fit. They have a roadmap for monetization if they haven't already monetized. The focus is now shifting from building a team, building a product, to perfecting the product, refining the product, expanding the team, acquiring customers, right? The Series A rounds typically require much stronger metrics, right? The investor is going to want to see some revenue growth, retention, customer acquisition efficiency. Even just being able to track those things is something you probably couldn't have done pre-seed. I mean, we talked recently about lower middle market buyout, obviously separate, but you need to have institutionalized, like, hey, what's your plan for renewals if it's a subscription business, right? You can't just have thrown something at the wall and hope it's stuck at this stage.
That's very clear. And I think it's really why I think it's so interesting to just focus on each of these distinct units as part of the fundraising rounds, because they're all very different, right? Like there's different things going on at different points of time. Sometimes when you look at early stage investing, you just think of it as just like one blanket part of the market, but there are very specific things going on at each of these times. It's important for investors to keep in mind when they're thinking about allocating money to venture capital investors, what part of the market do they play in? Are they focused on seed? Are they focused on Series A? Do they do a little bit of both? Do they do a mix of that in later stage? It's important to keep these things in mind too. So one question I have for you. So how are they structured? How are these deals structured?
Yeah, they're most commonly structured using safes or convertible notes. Okay. So these will delay setting a formal valuation. Rather, they'll include a valuation cap and a discount. So or one or the other potentially. Where in these discounts or in these valuation caps, they're providing, the investor the chance to get back in at a later point for a bigger amount at a lower price.
Yeah.
Traditionally, equity rounds with a fixed valuation are more common when you start the Series A.
Okay.
They can occur earlier, but again, typically it's going to be those discounted models where, I invest in Chris today so that 6 years from now I can invest in Chris again at the same price I paid today. Founders are typically aiming to raise 12 to 18 months of runway.
So dry powder, how much they can continue to keep the business afloat.
Exactly.
And get to that next stage.
Yeah, exactly. They want to be able to fund the business for 18 months, right? I want to have 18 months of money to burn, right? A startup with 5 engineers might raise $1.3 million because you need to pay those engineers at least over the next 18 months. So that's sort of a little bit around how they're structured at this really early stage. Again, it really is going to come down to those valuation caps and discounts.
Yeah, and there's nuances for each deal and structure and how it's being, done by the VC and the founder. But I mean, I think that covers like a very good high level summary for that too. again, coming back to Blue Tilt Ventures, they spoke a lot about what they look for in a business or a founder. That would be just interesting to kind of talk about a couple of these points too when you think about the VC and what they look for in a business, the founder, et cetera. Basically, it's a little bit of a mix. So team, market, product, traction. We always hear about, large TAM, right? So like, is it a big market that they're fulfilling? What gives them the right to win? How are the team? What's their backgrounds? Like a lot of these sort of like non-quantifiable. I mean, the total addressable market, yes, that can be quantifiable. Team character, drive, humility, willing to kind of go against the naysayers. Those things are like hard to put in like necessarily in a box, and which gives like this element of sort of like, a really interesting kind of pseudoscience of like how people are evaluating what companies to back and who to, which jockey to, invest behind. But generally what they're looking for, besides like grit in general, is a strong complementary founding team, large growing market, ideally, over $1 billion of TAM, very a compelling product with a clear differentiation. So, while, in these growing markets, there's a lot of people that like on the surface look like they're similar, or they're attacking the same thing, but where do they differentiate? How are they acquiring customers? Like, what is their business model? Like how all these things are so different when you get below the surface of evaluating a deal. Early traction. So looking at users, revenue, growth, the mix, and business model, again, coming back to that scale component. So due diligence at this stage really focuses on market size, product validation, competition, and then the founder's execution ability. So while the financials are limited, investors still assess unit economics and customer acquisition strategies, as kind of the big building blocks from a due diligence perspective. We talked a little bit about risk reward. So I think people think about these mega exits. Do they happen all the time? Absolutely not. I mean, unicorn became a thing not all that long ago.
Yeah.
There's a lot of unicorns out there, but when you think about all the venture-backed companies out there, not all of them reach even, a lot of them go out of business.
Break even. Yeah.
Right, exactly. So there's a high degree of risk. Think about you putting a lot of shots on goal to have this kind of power law dynamic where you get, a few investments in these funds to really carry the day. So high risk, high reward. Risks include overvaluation. Did I pay too much? Poor product market fit. Did I get it wrong? Is it really like not actually the right product to actually be successful in the market that I'm attacking? Lack of traction and long time to profitability too. So, sales cycles can take longer. Think about some of the government contracts, things like that, just enterprise level things. How long does it take? Can we get more sales in the door? Each customer has its own nuances. So these are kind of some of the just like risks around that. But so to manage this, investors diversify across companies and portfolios, industries, and even geographies. So they also stay close to their portfolio companies to provide support and identify problems early so they can kind of address them up front. So, you're not going to be able to solve everything. And it's always like, I forget the old adage, but when people like really say you got to get a little bit of money invested to really get, following the story and get really involved, I think that's really what this is talking about.
Got skin in the game.
So what's exciting stuff? What's going on right now? Current trends in the market?
Yeah, there's a lot. We talked earlier just about funds becoming more focused, right? So specialization is a trend here for sure, where you're seeing, a lot of specialization by sector. Maybe there's going to be people who only invest in early stage fintech, or only invest in early stage climate tech, or only founders who are, XYZ, or founders who have BCD background, right? So either getting, really specific in the type of companies or the type of founders to be backing. Something I think is really, really interesting too, though, is the geographic expansion, right? When we say early stage venture, where do you think of first?
Right, the U.S., Silicon Valley.
You think of Silicon Valley. If you're not thinking of Silicon Valley, you're thinking of New York. If you're not thinking of New York, you're thinking of Austin, Texas.
Yeah.
Right? Really just those three. I'm sure our Boston friends listening in will probably say Cambridge as well, but let's be honest, you're thinking of
healthcare.
Yeah,
biotech.
Exactly. You're thinking of San Francisco, New York, Austin, and then, we'll put LA and Boston in there too. 5 major cities that have run the scene. Now we're seeing so much more exploding outside of that, right? You're seeing companies in Europe that are, really, really compelling, potential global powerhouses. You're seeing Africa, Latin America. We just saw Maya Capital come through via the Form D filings, a Latin America VC fund. I'm blanking on the name of the firms. If anyone knows, put it in the chat. But there's a number of firms that are India specific.
India's become huge. I think like India's, it's often been referred to as like the new China or something like that too, just given kind of the regulatory uncertainty, the entrepreneurship environment there. But India becoming, we covered a couple fund launches over there last week.
Yeah, no, and it's very interesting. And it's, I think a little bit of it has to do with how just globalization has occurred at a dramatic effect since, the pandemic really, but these trends are happening obviously, before then, but that really, I think, escalated. And then the alternative structures. So I mentioned the safes a little bit earlier, but then you also have, revenue-based financing and then, crowdfunding platforms, right? I was just at the open of this call talking about how you can invest in
this film studio
for $100, right? So now I'm sure on that same website, you can invest in companies too.
Yeah. We covered a lot there. Come back to maybe we just go to talk a little bit about the exit return environment too. Ultimately these early stage VCs are looking for an exit to get paid back. So how does that come? This could become through, strategic acquisition, like in the case of Wiz that was acquired by Google, Alphabet, and that there's a number of investors there that are involved. Could be IPO, so taking the company public. Or even sometimes a later stage PE buyout firm. So, but it's a little bit more rare case. But I would say the first two are more common, particularly on the acquisition front. That said, planning for exits begins early. So that think about both the structuring the deals and then also aligning on long-term goals between the founders and investors as well. So, I think a lot of times if you look at a deal that goes public, or versus a company that is acquired by a strategic. Sometimes I think in the back of VCs' minds when they're structuring the deals themselves, they know what kind of preferred return, how it's going to get structured. So it provides them with a sufficient return that they're aiming for to hit their targets, but it also allows for strategic to come in the capital financing arrangements are such that they can they can do the deal. So in closing, again, innovation never stops. There's always funding available for new companies, particularly in the US, but we mentioned earlier, India, Asia, now Middle East too, and Latin America as well, becoming hubs for funding innovation in their own different ways. And these ecosystems are continuing to evolve and develop. And, it really kind of helps ventures really think about it. It's really just helps turn ideas into reality and help those ideas progress. So jobs, new markets, new tech, new gadgets, the stuff that we deal with every day, Airbnb, DoorDash, all these exciting things that we can't live without. This is all kind of backed by early stage venture companies and started somewhere.
Yeah. It's fun to always think about the things that you lived without for so long that now you couldn't. I mean, the obvious one for me, I couldn't do my job without ChatGPT.
Right.
I was doing it without ChatGPT. So what the heck was I doing then? It's just really interesting how quickly that became part of the routine.
Absolutely.
Well, cool. Let's just talk about some funds in the market right now. This will be specific to VC. And then we'll just jump into some other funds in the market across asset classes and jump sort of out of this deep dive topic.
Let's do it.
First, you have FPV Ventures. FPV, if you're not familiar, is a VC firm that partners with mission-driven founders across various stages of their life cycle with a preference for early-stage investments. The firm operates generalists, so not one of those industry-specific specialists that I just mentioned, but now switching over to one that is. So Camber Creek is raising money for Fund 5 right now. Camber Creek is a firm that focuses on technology solutions that enhance various aspects of the real estate sector. So, very specific sort of real estate tech, prop tech is sometimes what it's called, what they're doing over there, aiming to drive innovation in the real estate industry, which is pretty unique and then, if you're investing in Camber Creek, you can in theory be getting some access to real estate potentially through the technology services that are, serving the real estate industry. And then Logos Opportunities Fund 5, they're raising money. They're a San Francisco-based firm focused on life sciences with a particular emphasis on biotech companies. It's very exciting. They use a fundamental research-driven approach to identify and invest in companies developing transformative therapies, primarily in the therapeutics department.
I want to come back to FPV really quickly. It's a fund too. But let me just list off a couple of investments they made in Fund 1. Canva, which is everyone seems to be talking about now, and it's just the path to getting to this crazy ARR number is just insane. The time to do it, it really kind of is mind blowing when you think about it compared to legacy SaaS based business models and how quickly they got to those figures. So Canva's one, Databricks another, still private, but a Snowflake competitor. One of the largest private companies today, and Fig too. Hear a lot about Fig and Flexport as well. So Fig's building the next generation command line, and Flexport makes global trade easy for everybody. So think about kind of playing few different kind of adjacent industries, but some novel tech nonetheless, and some interesting, fun too. So very interesting team that seems to have a real knack for identifying some really unique early stage investments.
Yeah, it'll be interesting to keep following FPV. If given that those are the investments for Fund 1, I'm sure we'll see some FPV spinouts.
Yeah.
Some family offices popping up here and there. But anyway, transitioning now just to general funds and market across asset classes. I'll start us out with a private equity fund here. This is True Wind Capital. True Wind has filed with the SEC for its third flagship vehicle, that is True Wind Capital Fund 3. They closed Fund 2 in 2021 with an $817 million close. Fund 3 has not yet opened for subscription. Fundraising is expected to wrap within a year, though, so it'll be interesting to see if they can exceed the Fund 2 price tag in a year. Fund 2's LPs included a mix of pension funds, asset managers, endowments, foundations, family offices, and then some tech executives. And then, no doubt, based on that last comment, but these funds with True Wind do focus on technology and tech-enabled services. I've said this now 7 times on this podcast, but continuing that trend of sector specialist firms, popping up more and more and continuing to raise money for sector-specific strategies.
I've got one more here, but before we could go to closing comments, a couple additional points for this episode wraps. But Maverix, Maverix, this firm plans to spring launch for their second growth equity fund. This would be Maverix Fund 2. They're targeting $500 million with a $700 million hard cap. This follows the 2021 vintage Fund 1, which raised around $500 million. The firm pursues technology-enabled growth and disruption opportunities in North America, focusing on companies with $10 million to $100 million in revenue, typically investing $50 million to $75 million per deal. Why it matters: continued LP support for mid-market growth equity strategies. So this is kind of further down in terms of fund size, so the deals are taking. So you think about some of the other larger players in the space like Insight or TCV.
Mm-hmm.
This is a mid-market fund, so folks looking to get exposure to funds that are further down market. It also reinforces Maveric's differentiated strategic partnership model, which positions it as a collaborative capital partner rather than a strategic controlled buyer. That's a notable point. The firm targets a capital efficient segment of the market that often sits between VC and buyout capital, so it's appealing both to founders seeking both growth and operational support, and then also just continued momentum in the market for growth stage investing. So this, I guess, is one where you have a firm that's got some momentum behind it and a focused strategy and strong institutional LP base to continue to support them. So we'll track this one as well. So we've got a couple of upcoming Dakota events too as well before we wrap.
We do. If you are listening to this today on Friday, you just missed us in Atlanta. We were in Atlanta on March 26th, Wednesday. It was very fun. Some of those cities, Atlanta, DC, we're trying to get those cities into the mix. So we actually just announced that we'll be doing Washington, DC at the end of July. Listening on that. Actually also sort of a burgeoning tech scene happening in DC, which is fun. Mm-hmm. But what's on the slate right now, we have New York City on April 8th. Register for that right away. Those ones do always fill up very quickly. San Francisco the next day, actually, on April 9th. We have London on June 11th. We have our conference on June 17th. We also will do an event in Berlin around the Super Return on the 3rd of June.
Excellent. So there's a lot coming up. We also have our weekly webinars too.
A lot coming up. And the weekly webinars, we're still doing those. They're a lot of fun. Every Thursday, we're showing a live demo of Dakota Research. They're about 10 minutes long. Doesn't take much out of your day. Jump on, look at the platform, get a feel for if it's something you want to learn more about, and then set up some time with us to do it.
Excellent. Last thing we'll tease next week's episode, we're going to talk about the IPO pipeline. I think there's a lot of new companies that have, registered, or filed their S1s, and we've got all this data into the platform. So like firms like CoreWeave, for example, I think there's a lot to talk about there, and, some pricing changes more recently, but also what are the notable firms out there that are slated to go public in the year of 2025. So a lot to cover there.
Awesome. Thanks everyone for listening in. If you need us, we will be investing in horror movie film studios. Thanks everyone. We'll talk soon.
Thanks so much for watching the show. All of this information will be within Dakota Research, where you can go find it. And if you haven't seen Dakota Research yet, go to dakota.com and book a demo today.